So this one is about cars too. It says, "Hi, my car recently died on me and I need to get a new one. I'm 22 and I have $13,000 in my emergency fund. Should I pull 8 to 10K from this emergency fund to buy a car in cash? Or is now the time to use 23.8? What do you think?"
All right, give me a name for this person.
Tevin.
All right, so Tevin, I'm going to give you the quick disclaimer. We can't give you specific investment advice because we don't know all the unique circumstances surrounding your situation. And I love that you gave us some really good information. You're 22 years old. You have a $13,000 emergency fund. But what we don't know that we would really need to know is that $13,000 emergency fund, how far does that cover you? Like is $13,000, is that just like 3 months of living expenses when you factor in rent or mortgage and groceries and auto payment and insurance and all the stuff that you have going on? Or do you live super lean? Is $13,000 like 6, 8, 10 months of expenses? We don't know the answer to that question. It's going to be difficult to tell you specifically how lean you want your emergency fund to be. I will tell you this. One, I empathize with you because being like 22 and being young and having a car go out just sucks. It's like the worst. Like you're at the very beginning of your financial journey, in the very beginning of like your quote unquote adulthood life. And then you just get like, you hit right in the teeth with a car trouble issue. That stinks. But I love that what you're thinking about is, how can I do this the best way? How can I navigate this in a responsible way so that my future self won't look back and regret the decision that I made? I love that. Now, I do think, Brian, one of the reasons that you came up with 23.8, one of the reasons that was even a thing that was developed is so that we could have reliable transportation. And in my mind, Tevin's situation sounds like a reliable transportation type situation.
Yeah, I mean, I would, by the way, moneyguy.com/resources, go check out the financial order of operations. Also, full deep dive on what I'm about to share in Millionaire Mission. So go check that out too. But he gave us a lot of great details, and like we can't give you specifics because we don't know all your details, but I'll just walk through this like it was a case study. You know, if you look at step one, highest deductible covered, that's where you probably, I think that you're going to have more than enough with $13,000 to cover your highest deductible. If you look at employer match, you know, go compare that to whatever your day job is to see where you are. Because if you're getting 50 to 100% rate of return offered by your employer, don't pass that up. So then we get to step three, high interest debt. Now, here's the variable we don't know. What's the car loan rates? Because by the way, car loans in the past were sub 5%, but and maybe they are if they're subsidized by the manufacturer or the bank or the institution that's selling you the used car. But you know, sometimes credit unions have great rates. But I didn't realize until somebody was sharing with me that car loans now they can be around 15%, and I was like, "Holy cow! Are people really financing cars at 15%?" I would look at high interest debt, and you ought to have a question for us and say, well, what is high interest debt? And for somebody, it depends on your age. For somebody in their 20s, to me, historically, if you look at risk premiums, safe, you know, the safe rate of return, now it's not right now because you can get 5% on your cash right now, but historically, it's probably for somebody in their 20s, you'd want to put something around 6%. So I would look at your car loans and say, okay, if it's less than 6%, 23.8 is going to be your friend. Still put down that 20% on a good, reliable used car, but finance it over for 3 years. However, if that rate is greater than 6%, I mean, I think you have to hold your nose and unfortunately pay cash, try to find something very affordable.
So long as the emergency fund doesn't get too lean. Long as
you got to make sure you don't get below deductibles covered, or your highest deductible covered. That's what I would use as because you got to have a good, reliable car. So that's going to require something. But then, yes, I want you to keep going through the financial order of operations so that if it was an affordable rate, you can then make sure you're not, you know, extinguishing your emergency reserves and then get into your Roth and your employer's plan. There's all kind of opportunities. That's why we try to design the financial order of operations to be an all-terrain, all-weather type of system or tool so you can maximize your journey.
The only other thing that I would add on to there is I don't know what it means when you say your car died. I'd be curious to know, okay, is my car died, the battery went dead? Because, you know, going to buy a new battery is less expensive than buying a new car. If this is a a $500, $600 repair, and that repair will get you some more longevity out of the car, you ought to at least investigate that. Now, if it comes to where you have to throw a lot of money at this car that's not worth a whole lot of money, then sure. But make sure you don't just rule that out. Just because a car is old and just because a car might need a little TLC does not mean that it's immediately time to throw that car out and move on to a new one. So I would certainly go down that path to understand exactly what all of your different options are.